Okay, let's unpack this. We're taking a deep dive into something you probably interact with, well, maybe every single day, but rarely see behind the curtain.
Right.
Uber's latest Q2 2025 earnings call and financial reports.
Mm.
Think of this as your VIP pass, to understanding how a global giant like Uber is navigating both incredible growth and some very serious challenges.
Precisely. Our mission today is really to distill the most critical insights from these, let's face it, pretty dense
Yeah,
documents,
they are.
helping you grasp not just the headline numbers, but the underlying strategies and, maybe more importantly, the future implications. What stands out here, I think, is seeing how their bold vision translates into, well, tangible results and some significant investment decisions.
So let's start with that big picture then. What truly jumped out from Uber's Q2 earnings, especially on the growth and profitability front?
Well, the headline is genuinely impressive. You saw massive double-digit growth across, well, basically everything.
Okay.
Monthly active platform consumers, or MAPCs, they hit 180 million. That's up 15%. Trips surged to nearly 3.3 billion, 3.268 billion to be exact. That's an 18% increase.
18%.
And gross bookings reached $46.8 billion, up 17%. Or actually 18% if you look at constant currency.
Right, constant currency. So factoring out the exchange rate swings.
Exactly. The underlying business grew even stronger.
And on the profitability side, I heard those numbers were even more striking.
Absolutely. Revenue wasn't far behind, hitting $12.65 billion, up 18%.
Okay.
But what's really striking, I think, is the net income attributable to Uber Technologies, Inc. It jumped a significant 33% to $1.355 billion.
33%.
And their key operational profit metric, adjusted EBITDA, saw an even more impressive 35% increase to $2.119 billion.
Okay, that 35% jump in adjusted EBITDA, that sounds massive. So listeners may be wondering, what exactly does adjusted EBITDA tell us about Uber's financial health? I mean, beyond just being another profit metric.
Yeah, it's a crucial metric. It really focuses on their core operational profitability,
Yeah.
before things like interest, taxes, depreciation, and certain non-cash items.
Got it.
So it gives you a much clearer picture of how efficiently their day-to-day business is actually performing.
Makes sense.
And when you look at their cash flow, it just reinforces that efficiency picture. Net cash from operations soared by 51%.
51.
To nearly $4.9 billion for just the first 6 months of 2025. And free cash flow, up 53% to $4.725 billion over that same period. This robust cash generation is absolutely key. It gives them considerable flexibility. I mean, look, they ended the quarter with $7.4 billion in unrestricted cash.
So the takeaway here for you listening is that Uber isn't just growing, it's doing so in a way that's generating really significant sustained cash. How does this newfound financial muscle, really empower them to pursue their more ambitious, maybe more capital-intensive projects?
Well, it's a game changer, really. It allows them to invest aggressively in future technologies like AVs, which we'll get to. Right.
While simultaneously returning capital to shareholders. We'll talk about that too.
Yeah.
It's not just growth for growth's sake anymore. It's profitable growth.
Fascinating. Okay, moving beyond the pure financials then. Let's talk Super App. You mentioned vision. Uber's CEO has been emphasizing platform initiatives and the Super App vision quite a lot lately.
They have.
What does a Super App actually mean in the context of Uber, and what's the big advantage they see in it?
It's really all about getting you, the consumer, to use multiple services within the same app.
Okay.
Your ride, your Eats delivery, maybe your groceries now too. And the data they have is compelling.
Yeah.
They've found that consumers who use both mobility and delivery have 35% higher retention rates.
35%, wow.
And they generate 3 times the gross bookings and profits.
3 times.
Yeah. So that gives Uber a kind of structural marketing advantage over those modeling competitors, the ones who only offer, say, just rides or just food delivery.
That's a powerful incentive. But how exactly are they making that cross-platform magic happen? Is it just, clever marketing? Or are there deeper tech and organizational shifts at play here?
It's definitely a blend. A lot of it comes down to aggressive experimentation and the increasing use of AI. They're deploying these larger AI models to really understand consumer context, your history,
Right.
enabling hyper-personalized promotions, like maybe offering you a Starbucks coffee on your way to work based on your route and past orders.
Okay. Creepy, but potentially useful.
Exactly. And the organizational structure itself plays a role too. They've now put both mobility and delivery under one operational head,
Ah,
which
interesting.
allows for much more aggressive platform integration.
Less siloed thinking.
And the Uber One membership, their loyalty program. That
Uh,
seems pretty central to this whole super app strategy. What's the latest on its growth and impact?
oh, it's exploded, really. There are now 36 million Uber One members,
36 million.
which is a 60% increase. And these members, on average, spend 3 times more than non-members.
Again, 3 times. Consistent number there.
It is. Now, while the program has been highly optimized for delivery for a while,
Right.
it's still, let's say, earlier in its development for the mobility side, for rides.
Okay.
But they're pushing hard new features like something called surge savings. This was actually the #1 requested feature from mobility
With
users.
their savings, I could see the appeal.
Right. The aim is to drive membership by letting members save money during those peak surge pricing times.
Makes sense. And tying into that broader growth strategy, they also mentioned something. They called it a barbell strategy for audience expansion. Can you explain what that looks like in action for Uber?
Yeah, think about it like targeting everyone, from the most budget-conscious user all the way up to the premium customer.
Okay, at the two ends of the spectrum.
Exactly, the barbell. So on one end, you have lower-cost products like Moto. These are the two-wheelers, right, in developing markets.
Mm.
That's now over $1.5 billion in gross bookings and growing like crazy, 40%.
40%. Wow.
Then on the other end, you've got premium offerings. Their premium ride business is over $10 billion and growing 35%. And their reserve business, booking in advance, that's growing 60%.
60.
So the core idea is bring people onto the platform with one service, maybe a lower cost one like Moto.
Get him in the door.
Right. Then introduce them to other things. Maybe that Moto user uses a regular Uber for a date night or, when it's raining.
Uh-huh.
And this really underscores just how massive the untapped market still is. They said only about 20% of adults 18 and older in their top 10 markets are currently using the platform monthly.
Only 20%.
Yeah.
Still huge room to grow then.
Absolutely.
So it's about casting a really wide net and then kind of reeling people in for more services. It sounds clever, but are there any, inherent difficulties in trying to cater to such a wide spectrum of users and product types all at once?
That's a fair question. I mean, the challenge is always maintaining focus and ensuring quality across such diverse offerings. But their strategy seems to be built on leveraging the core platform's underlying tech and, crucially, those network effects.
All right, let's pivot a bit and look ahead. Uber is clearly making some huge bets on the future, particularly on autonomous vehicles, AVs.
Big time.
What's the state of their AV deployments and partnerships right now? It sounds like they're really pushing forward, maybe faster than some expected.
They are ramping up significantly, yeah. Uber has expanded AV operating zones with Waymo in Austin, also Abu Dhabi with a company called Reride.
Where?
And they've launched exclusively with Waymo in Atlanta.
Atlanta too, right?
And just the sheer number of new partnerships they announced. Companies like Baidu, Lucid, Neuro, Wave, Momenta, Pony. It signals a really serious multi-pronged push.
That's a lot of names.
It is. And what's genuinely surprising here, I think, is the efficiency they're seeing from these Waymo AVs.
Oh, yeah. How so?
Get this. They're actually busier than 99% of human drivers in terms of completed trips per day in Austin and Atlanta.
99%. That's,
Now.
wow, busier than almost everyone.
Right. Which kind of flips the script on early AV expectations. And they also mentioned this creates a sort of positive halo effect, excitement among consumers.
I can imagine. That efficiency stat is genuinely surprising. But, while AVs are clearly the future, or a future, they're also a massive capital sink right now.
Oh, for sure.
How is Uber balancing this really aggressive investment in a still unprofitable technology with their stated commitment to returning capital to shareholders? Seems like a bit of a tightrope walk.
It is, absolutely. But this is where that robust cash generation we talked about earlier comes right back into play.
Ah, okay. The fuel.
Exactly. They're investing in both software and hardware players. There was a $300 million equity investment in Lucid.
Right, the EV maker.
And an investment in Neuro for a global robotaxi program. They really emphasize that they can afford to invest aggressively in AVs, partly by recycling proceeds from minority stakes they hold in other companies.
Ah, selling off bits of other investments.
Precisely. So while AVs aren't profitable yet, Uber expects to build scale for future profitability, much like they did with past growth bets, like Uber Eats, which also took years to turn profitable.
Good point. History there.
And they're exploring various partnership models for AVs, everything from a merchant model, predictable revenue for partners, to an agency model based on revenue share, and even potentially models involving asset ownership down the line.
Interesting.
The immediate focus, though, seems to be securing those OEM partners, the car manufacturers, for affordable hardware. And they clearly believe the market will have multiple winners.
Not just one dominant player.
Right, and Uber aims to be one of the key platforms connecting users to those winners.
Okay. So beyond self-driving cars, how else is Uber leveraging its, immense tech infrastructure and global reach? Are there other innovative ways they're using their platform that may be flying under the radar?
Absolutely. They're starting to externalize certain core capabilities. For example, their advertising business.
Right, ads in the app.
Yeah, leveraging their massive audience for pretty high margin revenue. And then there's something they call Uber AI solutions.
What's that?
This is fascinating. Nearly 9 million earners on their platform, drivers,
There's
couriers,
9 million.
are doing things like data labeling, translation, and algorithm tuning for AI developments worldwide, like micro tasks.
So using their workforce for AI training data.
Essentially, yeah, it's less about immediate profit right now and maybe more about accelerating market adoption and just utilizing their existing vast global network in completely new ways.
Leveraging the network. And speaking of capital allocation, they just made a huge announcement about share repurchases, didn't they?
They did. A big one.
What does that signal to the market and, to you, the potential shareholder?
Well, a new $20 billion share repurchase authorization announced just in July. That's on top of the roughly $2.6 billion remaining from the previous $7 billion program.
So over $22 billion total authorized.
Exactly. That combined authorization represents about 12% of their entire market cap. It's a very clear statement of confidence in their future cash flow and likely a signal they believe their stock is undervalued. It underlines a commitment they stated to return at least 50% of free cash flow to shareholders over time.
Okay.
And they're acting on it. They already reduced their share count by 1% just in Q2.
Got it. And they also made an acquisition recently.
Yes, strategically expanding. They acquired an 85% controlling stake in Trendyol Go.
Trendyol Go.
It's a meal and grocery delivery business in Turkey, cost about $697 million. So pushing their delivery business into a significant new market.
So yeah, balancing those aggressive future bets like AVs with direct returns to shareholders and strategic M&A, that's a pretty tight rope to walk.
It is, but they seem to be managing it, at least based on these numbers and announcements.
Right.
These actions really demonstrate that confidence in sustained cash flow generation. They're strategically balancing these significant investments in future tech with strong shareholder returns. It's all about, profitable growth and securing their long-term market positioning.
Okay, but every giant has its Achilles heel, right? Or at least some significant hurdles.
Absolutely.
What are some of the biggest challenges or potential headwinds Uber's facing right now?
Well, the perennial one, I'd say, and maybe the biggest operational unknown is driver classification.
The employee versus independent contractor debate. Still ongoing.
Still very much ongoing. You have lawsuits, regulatory pressures globally, arguing drivers should be classified as employees. We've seen this play out famously with California's AB5. There's a lawsuit from the Massachusetts Attorney General right now. Any successful widespread reclassification would fundamentally alter their business model.
How so, exactly?
Well, it could impact how revenue is even presented on their books, and it would almost certainly significantly increase expenses for things like benefits, minimum wage guarantees, taxes, you name it. So while Uber defends its independent contractor model, emphasizing flexibility for drivers.
Right, that's their main argument.
A forced reclassification could lead to significantly higher costs for them, which likely means potential price increases for you as a user, and maybe even fewer drivers available on the platform if the economics change too much for them. It's a huge variable.
Yeah, that could massively change the whole equation. What about the competitive landscape? The rideshare and delivery markets still feel pretty cutthroat.
Oh, they absolutely are. Uber operates in highly competitive, often fragmented markets, and crucially, with pretty low barriers to entry and low switching costs for users.
Meaning, it's easy for me to just switch to Lyft or DoorDash?
Exactly. Or for a driver to switch apps. This often forces Uber and their competitors to offer significant incentives and discounts just to attract and retain users and drivers.
The coupons and bonuses.
Yeah. Consumers often shift to whoever has the lowest cost or maybe the best perceived quality at that moment. And drivers, naturally, gravitate to the platform offering the highest earnings potential. So the challenge is maintaining network liquidity, that delicate balance.
Enough drivers for riders, enough riders for drivers.
Precisely. Maintaining that balance without constantly eroding your margins through those incentives. It's a constant push and pull.
And safety. That's always got to be a critical concern for a platform like this, connecting millions of strangers. What are the risks they're managing there?
Well, obviously, there are risks from user actions, both riders and drivers. Potential inadequacies in background checks are always a point of scrutiny.
Yeah.
And they specifically mention the increased danger for two-wheeler drivers. The Moto and Eats delivery folks, especially in congested city traffic.
Right, more vulnerable.
Beyond the direct costs of incidents, liability, insurance, these things can lead to really negative publicity and just higher operating costs overall. Managing that safety perception is paramount for brand trust, especially as they expand into more varied services and different types of vehicles.
In the regulatory environment, you touched on driver classification, but it seems like it's getting increasingly complex beyond that too. Local rules, new AI laws.
It's definitely a complex web, and it keeps evolving. You have international complexities, different rules in different countries, different cities even, local licensing requirements, potential caps on delivery network fees that cities might impose.
Right, like we saw in New York.
Exactly, limits on surge pricing in some places. Then there's increasing scrutiny from competition authorities globally. Data privacy laws like GDPR in Europe or CCPA in California add another layer. And now new AI-specific regulations are coming online, like the EU AI Act that just came into effect.
How does something like an AI Act impact Uber?
Well, it could govern how they use algorithms for pricing, for matching, for evaluating drivers.
Right.
It adds compliance burdens. These regulations aren't just, legal hurdles on paper. They can directly impact operational costs. They can affect their ability to attract and retain drivers, for instance, by increasing the costs associated with certain vehicles or requiring specific driver qualifications.
And climate policies too.
Yes, that's becoming bigger. California's requirement, for example, for 90% zero-emission vehicle miles by 2030 for rideshare fleets.
That's ambitious.
Very. And things like London's congestion charges. These can increase operational costs for drivers or potentially reduce driver supply if it becomes too expensive to operate certain vehicles.
Oh, okay. Lots of regulatory pressure points.
Yeah.
Finally, the broader economic climate. How is inflation, economic uncertainty, how's that impacting Uber?
Well, inflation obviously impacts fuel costs for drivers, food costs for restaurants on Eats, labor costs. That affects both the supply side, drivers and merchants.
That makes sense.
And potentially the demand side, too, if consumers tighten their belts. What's kind of fascinating here is that tricky economic conditions can lead to that barbell shift in consumer behavior we talked about earlier.
Right.
People might opt for lower-cost Uber options, like pool if it's available, or maybe even switch to public transport sometimes. That could potentially impact their higher-margin services like Uber Black or premium rides. So it cuts both ways.
So after diving into all of this, what's the grand takeaway from this deep dive into Uber's Q2? We've seen a company, firing on all cylinders financially, making these huge bets on cutting-edge tech like AVs and AI, but also wrestling with some very real, very complex operational and regulatory challenges. You, listening, hopefully now have a much clearer view of their strategic plays and the hurdles they're constantly clearing.
Indeed. I think the critical insight is really their strategic balancing act. They're driving aggressive innovation, pursuing market dominance, while simultaneously committing to profitable growth and, importantly, significant shareholder returns. It's a very dynamic tension at play.
And that leads us, I think, to a fascinating question for you to consider as we wrap up. As Uber continues to expand this super app vision and push deeper and deeper into autonomous vehicles, how will they ultimately navigate that delicate balance between innovation, profitability, and all that regulatory compliance? And maybe more fundamentally, will the human element of their workforce, the drivers, the couriers, remain a core part of their strategy long term? Or will technology gradually redefine what rideshare and delivery truly mean in the maybe not so distant future?
Yeah, big questions.
Definitely something to ponder the next time you tap that app. Thanks for joining us for this deep dive.